obviously, overall in life, when you look at investing or parking money long term because the situation is stable, these are pretty much the overall 7 choices you have, what I call the big 7, to actually park your money. Okay? And you know I'm telling the truth. I'm dressed up today. I've even got the Soul Glow 1980s t-shirt on. See how many people even get that reference. I don't even think many people will. So, obviously you have liquid things, savings, checking, CDs at your bank, which are not really that liquid unless they're short term. You got your infamous equities, which is stocks, in other words, publicly traded companies. You got your debt, which is bonds on the open market, corporate, government, muni, depending on your tax situation. You got real estate for either a second property for tax write-off, a business property for tax write-off, which is what I do, or of course rental properties or primary residence. Then you've got collectibles. Collectibles can be, you know, stamp collecting, coin collecting, magic cards, Pokemon, Yu-Gi-Ohs. It could be Mujik the Goothering. It could be anything you want. Anything that falls in that collectible basket. Then, of course, you got crypto. I have officially added that as a class because I can't predict the future. And all I know is it's a big thing, and a lot of people get mad when I don't include it. So I did put crypto as one of the big 7 now. Whether you're looking at some sort of Litecoin, Ethereum, or, of course, the Big Daddy, Bitcoin, or whatever you want. And, of course, the last but not least is what a lot of more higher net worth wealthy individuals do, and they look at startups. In other words, you inject your money instead of investing in a conventional thing, you inject your money in investing into another person who's starting a business. So, with all that being said, let's see what we got here, everybody. We got, so this guy, so pretty much, this is interesting. Let me give you some interesting data points too, everyone. So, on average, the gentleman has $3,000 left over per month of net income after paying all his bills. So we're going to start, let's kind of stop right there. That really stands out to me. I don't know, there's nothing about if he has, you know, a boyfriend, girlfriend, a wife, 10 kids, 47 kids. I'm not really sure, but I can tell you this. If you're making $160,000 a year, and you've only got $3,000 left over a month, that kind of gets my attention right out of the gate. To me, that immediately makes me say, okay, wait a minute, $3,000 a month, that means you only have $36,000 in extra free cash flow per year on average, based on an average of $3,000 a month. That's only, I mean, what is that, 20%? Which isn't bad. Compared to most people, 20% is good, but when your income's 160, let's say that's what do you guys think, 125 net after taxes? So where's the rest of the money going? Because I'm looking at your real estate situation here, and if your mortgage is you only owe 180K, you have a low rate, and this, I mean, the actual mortgage payment on this particular setup with escrow, taxes, insurance, and, you know, I mean, you've got to only be paying, what are you guys paying? What do you think he's paying? $1,500 a month? You know, so $1,500 a month, that's only, what is that? 1,500,000, that's $18,000 a year for housing. It's pretty low. Even with utilities, maybe internet, cell phone, insurance, a bunch of fugazi, fairy dust, you know, I feel like someone's bamboozling somebody here. I want to know how you only got $3,000 left over a month. If you're starting here, that's your expenses. You got no debt. You got a crap ton of cash in the bank. Where's the rest of the money? That's the very first thing that stands out to me. You've saved a ton. You've obviously got, you know, 5%, which means you're doing 5% of your gross income because they're matching 5. So 5% immediately, 160,000, 10% would be 16,000, 5% is 8,000. So he's got 8,000 a year going into the retirement, and the company's matching with 8,000. So I feel like there's still a huge chunk of money missing. And again, I don't know. Maybe this gentleman, maybe he likes going out at night. Maybe he likes the ladies of the night. I'm not really sure. I'm not here to judge. I'm just here to question. So that's the first thing that stands out. The next thing, he asked me, Rudy, what else do you think I should do? Do you think I should refinance or do something with the actual house I'm living in? Should I do like a refi to a 15-year versus a 30-year that I'm currently in? All right, in my opinion, right out of the gate, I'm gonna be very blunt with everybody. I do not like refinancing. I don't like cashing out equity. I don't like rolling over or combining it. I'm not a fan of saying, Rudy, you know, I've got 100 grand equity. I can refi and get a check for 90 grand and refinance and rebuild up the principal balance of my debt. I'm not a fan of that type of approach. It's a personal thing. I don't like that. The cost that this gentleman would have to incur to refinance that mortgage, he's got 4.5%, 5.5%. You could take 14 grand from your flipping $100,000 checking, you should be dumping that. That's the first thing you should do on this whole video is I would say dump the 5.5% one. I would dump it. I would keep the 4.5 because it's below my magical 5 number. Any debt that's below 5%, it's kind of I hate to say it this way, it's almost like using someone else's money almost free. When your interest is below the magical 5, I have a hard time telling people to really give it all she's got. Go full throttle and pay it off. I can't get behind that because it's just such cheap money. You're just using banking, government, Federal Reserve money. I just let it be, man. Maybe still pay a little bit extra principal, maybe 5-10%, but just don't dump all this into that. I just don't think it's really. But I would kill this. I would immediately knock that thing out. I think that rate, that second one, I would chop it off. So, but why refi? Even if you lose a couple percent of the whole balance, and if you got 200 grand, if you refi and they charge you 1-2%, you're gonna lose $2,000, $3,000, $4,000, $5,000 in refi fees. Why? Just pay down the principal. That happens all the time. People always ask me about refi or rolling over, consolidating loans and debt. And if your rate is that good, there is no reason for you to pay the fees versus just taking the money that you would pay in the fees and reducing your principal or increasing your monthly principal payments in addition to the minimum payment. That's always going to be the best end result. And that's why I'm wearing the Soul Glow shirt, because I got crazy hair. So here, that's what I want to start with the housing on there. So obviously now that we've got the basics out of the way, the dude's got a good stable life, and he's pretty much just saying, hey, Magic the Gathering investing can be stupid. Real estate's too expensive. Everybody's, very arguable on this topic. So what do I do? What's the option here? So I'd rather ask the guy with a creepy pink visor. So what do you guys think? Look at the board. What do you think? So now that we've established this, looking at the board here, in my opinion, what I think needs to be focused on is the 7 categories. We all get older, and eventually you just become the old creepy guy at the party. And at that point in time, you can't just go to a college party when you're 40, 50, 60 years old, because then it's just an old creepy dude. And you have to understand that we all have a certain mortality in this life. And we're all going on a one-way street, and we all have the same conclusion. The key is, as you get older and you progress through life, you want to make sure the future portions of your life are enjoyable, because nobody wants to be stressed being a Walmart greeter or working fast food when they're 60, 70, 80 years old. It sucks. Every time I see that, it sucks. I see it all the time when I go to Taco Bell in the drive-thru and things like that. And I mean, they're usually very nice people, but no matter how happy they are in the moment or with their job, there's nobody out there that can honestly tell me when you're 60, 70, 80 years old, you want to wake up every day and you want to go work the drive-thru or work retail at minimum wage. Nobody out there genuinely wants to do that, even if they don't mind their job. I go to Chick-fil-A all the time. I take my little one, the family, we do that stuff. And we love going. There's some older people that work there. They love their job. But at the end of the day, if it was up to the individual who's older, you and me and everybody watching this video, when we're older, we would rather be at home, maybe spending time with family, our kids, grandkids, our significant others, or honestly just relaxing, watching movies, playing video games, maybe just going outside and doing what Rudy does. Sit on the front lawn, get a lawn chair, and just yell at the cars when they go by for driving too fast. Nobody wants to work when they're old. But unfortunately, if you want to have fun when you're young, you can do it. But you will pay the price, unless you become that 0.111% outlier where you just hit it big and you are the one in a million who has millions of dollars. And it's a nasty thing. It really is a boring, crappy conversation, because the sad truth of all this stuff is most of you watching, I would say over 50%, and most people in the United States, as they get older, they're going to have a tougher life for not planning. And that is the nasty, crappy truth. That's why, even making these videos, even if 1 or 2 people say, you know what, maybe I should try or do one little thing different. That is a huge step for many people, even if it just affects a couple people watching these videos. It's something that you really shouldn't be in denial about. I did years of being a broker and an advisor, and the stories and the people I saw. The nasty truth of it is, it sucks. It's crappy to see it. And unfortunately, when 50, 60-year-olds, you're trying to work with them and their life savings is $5, $10, $20,000 and they're in their 50s, there's not much positive I can tell the individual. It is what it is. And, you have to understand the core principles. To retire, the definition of retirement means to stop working. In order to stop working, you have to have something that replaces the income that you're currently living on. That's really all it comes down to, everybody. I don't care about magic or houses or stocks. Or the end result is to stop working, which none of us want to work. We need to replace that money coming in with something else, whether it's rental money, interest on your savings and checking, or of course some sort of nest egg, or you have so much in collectibles you can just sell a collectible every month and live the rest of your life. You need to have something in place so that you can step away from that job and that boss who treats you like crap, and you need to have the cash flow continue. It is what it is. Final thought on this video, everybody, is just remember this. I could easily stop making videos, blow my money, get an exotic car, act like I'm hot stuff and drive around, wear fancy suits and name brand, do all this stuff. And I could probably do that for many years. But the question you all have to ask yourself is it smart to take 3-4 years and burn through the money and live it up at the expense of 20, 30, 40 years of not being able to enjoy your life? So I don't know about you guys, but working and doing the right thing for maybe 5, 10, 15 years and taking care of your future, and then when you're all set, having the rest of your life, 10, 20, 30, 40, 50 years of your life of being taken care of because you sacrificed this little block of time, that's a pretty good trade-off to me. I don't know about you all, but I would rather work my butt off and do all these boring things for 5 or 10 years, knowing that I'm going to have 30 to 40 years, like a 4 to 5 times payoff of doing whatever I want and enjoying my life when I'm older with my kids, grandkids, and family and friends that are around the country, in the world. To me, that's the grand scheme. And it's tough to sacrifice in the short term, but it will pay off. For 99% of everybody, it does. There's always exceptions, but overall, the odds are that if you really do the discipline, do the right thing with the money. It's not always about working hard, everybody. It's about working smart and being cautious. And that's where a lot of people screw up. A lot of people watching this video probably make more than this. A lot of people make less. But the reality is, no matter what you're making, whether it's $30,000 a year, $50,000, $100,000, $160,000, $300,000 a year, it doesn't mean anything. I had friends who were stockbrokers also in 07, 08, 09, 10, and they made $250,000 a year. And I'd visit them in their apartment. Chair, boxes on the floor, nothing to show for it. Alcohol, parties, everything. Dead broke. $500 in the bank, waiting for their next paycheck. And I know as the crash unfolded, they lost everything. Because you can't predict the future. You have to prepare. You have to be the boring fuddy-duddy like Rudy. And at the long run, you'll see the results. But it's a nasty, boring ride. And people don't realize how unsexy and boring it is to actually be an investor. A real investor, not trying to flip and make millions and try to do this crazy risk gambling. Actual long-term investing is really boring. Buy a lottery ticket, or they found buried treasure, or they bought a painting that turned out to be Van Gogh, and then all of a sudden they're worth hundreds of millions. That does happen. But in reality, most of us are normal people that have a lot of choices every day, and we choose what path to take. Every day is a series of choices. Most of the time, we make the same choices every day because that's human nature. We take the path of the least resistance, the least anxiety, and the most safe outcome. That's what humans do. So, for most people, I get messages all the time. They don't see a path forward anymore. Inflation's too high. Nothing goes up in value. What am I supposed to do, kind of thing. And that's where I like to counter argument, and I like to say things like, well, I understand it's a different era, but in my perspective, in the Rudy perspective, and I know many of you out there are going to say, well, it's easy, Rudy, because you've already made millions, and you don't have that same perspective, and your glasses are tinted now, and I respect that, and there is some truth to that. I will not be able to see it as clearly as I used to because I don't have that risk that I used to have of losing everything going to zero anymore. That is no longer an option because I'm so diversified. But for many years, in my teens and 20s, I was in pretty rough shape. So the reality is the biggest thing you can control is that day-to-day choice in how much you want to work. You can't control anything else. I can't control no matter what people think Rudy's pump and dump and this and that on collectibles or stocks, or I'm pumping this card or this box or this game. No matter what the internet mindset may be on the social media flavor of the week, the only thing we can really control is how much work you're going to do and what you're going to do with yourself, how you're going to treat your own body, how many hours of inputting labor you're going to put into the machine, and how much, actual utility or money comes out of that machine. Because when you're not filthy rich or wealthy, it's very simple, okay? And that is, you don't have the resources, but most likely you have a lot of time. You need to input as much time as you can to convert it to as much resources as you can to build a foundation, a roof over your head, and get ahead and build a safer, better future for yourself, because you're greedy, just like me, and of course your loved ones, family, maybe your children, your future generation. That is kind of the outlook of it. That's how I view it. We've all been in situations in our life, unless you're a trust fund kid or something, which I'm jealous. I wish I had that. It would have saved me a lot of heartache. But I mean, we've all been in situations where we have periods of our life, we have a lot of time. And it's up to each of us individually to determine how much time we want to exchange for money or resources. And then take that money, which is a utility, and take that utility and build something, exchange that for something, or put it into something that can either generate more money or adjust upwards in value long term. That is the basic principle of economics and finance 101. So when you approach all these diversified categories and choices you can do, you have to first have the right mindset. And that is, you will never get the best price, and you will never sell at the perfect sell point. If you can overcome that with yourself, that alone is going to help you move forward. So they're trying to take shortcuts. Options are shortcuts. They are situations where people are trying to get rich by using a small amount of money. We've talked about it many times on this channel, folks. On part 3 of this video, we've discussed it with you all, and we've said many times, you cannot take shortcuts in life because you're stacking odds against you and you're taking excessive risk. This is a great example of, again, higher net worth individuals, people with big collections. They don't do this kind of stuff, folks. They don't take these kind of risks. I don't take these kind of risks. I think it's crazy. It doesn't work. And if it does work, you get lucky, then you get confident and cocky, and you go back for more until you lose. And like I've tried to explain to everybody in this YouTube channel, when it comes to collectibles and stocks and bonds, you have to manage risk. If you take shortcuts, you're gonna get slaughtered, and you can't do that, because what people fail to understand when it comes to buying and selling contracts on Wall Street is it is skewed against you. You're not betting on whether or not you're going to be right or wrong. You're betting on the timing of being right or wrong, and the timing is the ultimate black swan, impossible thing to predict in this world. You cannot predict timing of anything in this world. And trying to place any form of financial instrument on betting with timing and betting on time and when something's going to happen on a timeline is the ultimate Timmy life and Timmy move of failure, because you're setting yourself up for excessive risk and excessive losses. It's not very smart. Same thing with this. You can get 100 good investments, but when you get one wrong one and you're playing down here in the penny stock league, you get wiped out. You're done for life. Don't believe me? Google optionsellers.com. Look what happened to that guy. Look what happened to his company. Go Google long-term capital management hedge fund. Go Google there's the endless stories of finance entrepreneurs and case studies is all over the internet in modern times. You can read, just go to a bookstore and just pick up random books and start reading anything with finance, theory, anything, entrepreneurship, business, yields, risk-taking, management, all of it. Making fun of you tends to be that contrarian good entry point. I understand that taking extreme amounts of risk will eventually lead to crapping out. The gambler's fallacy will get you. And you need to take these things into consideration. Look at the 0, the 20s, the 20-25 versus the 90%. All for pretty much the same approximate returns. The difference is how long? 1 year, 2 year, 3 year, 5. The difference is pretty much the time frame. You are moving the time frame and it's adjusting the risk of the downside. Does that make sense? I hope as long as a couple people out there understand this principle, the whole video is worth it. That is like I said, this is the stuff that's the most important to think about long-term with Magic. Long-term with actually all investments, everybody. It has nothing to do with Magic. As a whole, the mindset of risk-reward is so imperative. It's so important. Because, I mean, you have to acknowledge, if you took 10 grand and you put it in this, or this, pretty much over a couple year period, the return of pretty much these top three are going to be relatively the same. Maybe plus or minus 10, 20%, but overall, there's not much of a difference. The only one that has the big difference is if you put 10 grand into this penny stock type of card, yeah, your 10 grand may go to 100%, 20 grand, but the odds are not in your favor. And why are you going to take that much risk? Because it's not about money. It's about time, everybody. You need to remember that. Time is the ultimate everything in this world. You get one shot. There's no do-overs with time. We can't reset the clock, and in a long enough time frame, we all have a survival rate of nothing. We all eventually end, and you have to keep that in mind and calculate and make sure you don't set yourself back. I hope you guys learned something today. That's really, I don't think I have much else to say or add to the video. It's boring. I've been doing it for 10 years. I think I've made some money, but that's very common because again, unfortunately, this stuff isn't sexy, everybody. It's not fun. This stuff isn't that exciting. The reality, not like Wolf of Wall Street in Hollywood, the reality of investing in Magic and in real estate, just like I've showed you guys, and people watch my videos. Look at the old cards Rudy's showing. Oh my God, the guy's got millions sitting on the table. It's on. The reality of dealing with this stuff, it changes how you look at the old cards. It changes how you see the real estate. And, it's not a big rush. It's not exciting. Normally, it's pretty boring. It's a slow drip. It's like watching paint dry for an investment to work, and unfortunately, that's how it is, I don't engage in trying to speculate on 10 different standard cards and what's going to get banned or what's not going to get banned or what's going to be the hot deck in standard tier 1 point tier 2. And, because first of all, the money is too small. And more importantly, the risk is too high for the potential reward. The risk is this high, and the reward is kind of it's just not there. And so for me, I like to have a more balanced approach when looking at this stuff. But it does take a rewiring of the brain to because we're all in this mindset now of just this instant gratification, smartphone, social media, quick, everything's gonna be fast, And it's not really like that. It's just not really like that, everybody. Investing, for the most part, 99% of the time, it's boring. Rudy, why don't you just sell some of your reserve lists and go buy like a Ferrari or something instead of like the old truck you drive around, or because it's not about that. The cards have meaning. There's a purpose in long term. Whatever you're into, whatever category you're looking at, there are many moments in life you have to overpay, and that's okay. So why, do you ask? The point of the why is that it's a battle against yourself, and it's a battle against your own buyer's remorse. I tell people how after I bought that Alpha PSA 10 Underground C, I had buyer's remorse, and I called the company to return the card because an Alpha Underground C was only $400 or $500. And I had paid about $850 or $860 with shipping. I paid about $850 for the card, and it was almost double market price. And I felt like I had such buyer's remorse and regrets and uncomfortableness. I legitimately tried to return it. The only reason I didn't return it is because the company just said, hey, no big deal, but we're going to charge you a 10-20% restocking fee because of the cost and credit card transactions and blah, 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 shipping. And I said, hey, you know what? I'm not going to bust your balls. That's fair. I'll keep the card. That's the only reason I kept the card. Obviously, $850 investment went up 100x, and it's worth $100,000. Still have it. I don't care if it goes to $1 million. I'm never going to sell it. I mean, it's such a piece of me and historical path of what's happened. It doesn't really have a dollar amount to me. And a lot of the things I do on this channel and a lot of things we discuss, those of you who've been around a long time, you've learned that it really, no matter what you'll read or people new to the channel, the money is very secondary because as I've told everybody, when you start a business or you try to design or build something, if you know what you're doing and you're very passionate about it, the money will come naturally. You don't need to try to scam people. You don't need to try to manipulate people. Just build the business, enjoy it, put tons of hours. I'm talking, if you're not doing minimum 60 hours a week, then I'm sorry, you're a slacker and you're lazy and you're making up fake excuses that you don't have time. Please, you're watching stupid stuff and you're watching Netflix, you're watching YouTube, blah, blah, blah. The point is, I knew eventually the money would come. Now, I never imagined in a million years things would get to this level of how expensive, and how big the channel and everything's gotten, but I knew the concept in the fundamental principle of alpha investments and collectibles would hold true long term. And it did, a little bit better than I thought, but that's really the history there.
There's another really important point to keep in mind. Like, people are scared to go buy certain asset classes, right? And that's always the case. When you're trying to buy something at its right time, at its lows, if something was at its lows, it's because everybody feels so negative about it. And that's just something to really embrace as an investor. Something being an unloved asset literally means it will be at its bottom, it's at its lows.
I just feel that the real world doesn't understand the amount of money, the amount of players, the amount of people, the amount of distributors, the amount of stores. I don't think the general public in the real world understands what's really happening every day. I feel most people online and younger individuals who may be joining the market or have no experience in this market, they're very emotional, they're very volatile between scalpers and manipulation. I've seen some of the most wild stuff over the years. And to this day, I still see new things that blow my mind. And I guess I become more concerned if that kind of negativity stops. As long as we see the skepticism, I think the bull market will continue in collectibles. The day everybody thinks Flesh and Blood Monarch is going to go to $2,000 is the day that we're probably going to be in some serious trouble. Because whenever everybody agrees on the same thing, that is usually the sign of a top or a bubble. Nothing has changed. Nothing has changed. The more you think things change, the more they stay the same. What happens is you feel differently as we get older, but nothing has actually changed except your perspective. And that alone makes you believe that the world has shifted. The world hasn't really shifted, but it's evolved some. But the flow of everything and the principles of everything, whether you're investing in stocks or rental houses or collectibles, the principles of everything are still intact. They will be in 5 years, they will be in 50 years, just like they were 5 years ago and 50 years ago. Nothing brains out there, Timmys. The funny thing is, all we do is remember it. Time is a very finicky thing. Technically, the only reason we have memories is it's a defense mechanism. So we know what to do and what to prevent to not hurt ourselves next time and be smarter on the next day. Time is a finicky, silly philosophical thing. But I do know, as companies in capitalism and business owners move forward, they're not going to sit around and have empty restaurants because they can't hire people. And they're only going to be willing to raise the salary so high before the yield on the employee does not justify the higher number. The mathematics, the finance doesn't work. If you're not familiar, when the government passed the last round of stimulus checks for the American people, as with all things in life, there's a bunch of caveats and hidden things attached to it that nobody knows about until after it's done. So, if you're not familiar, this is going to be controversial and we're going to go through it. If you're not familiar, after getting endless amounts of messages, I decide I will cover it. I'm just in a feisty mood today. And if you're not familiar, any payment processing merchant companies like PayPal's and Cash Apps and Venmos and Zells and all this crap, the biggest one being PayPal, normally they only generate a tax form for the IRS if you break over $20,000 in deposits or sales, and they generate what they call a 1099-K. Now, in this new law or new system in place, they are now adjusted the numbers where all you have to do is have at least $600. They lowered the threshold from $20,000 all the way to the floor to pretty much $600, which is going to capture a tremendous, huge chunk of the population that's lower income, small business, starting out, And I know what most of you are going to say. I know what you're going to say. Well, Rudy, those people should have been paying their taxes and reporting it anyways. You're probably right. You're probably right on that. I'm not here to discuss how all these individuals or a college student or a high school student or anyone who sells one card for $700, whether they report that one card to $700 that they received to the IRS because they paid $400 for it and they made $300 profit. I'm not here to discuss that. That's up to individuals how they want to do their stuff. For big stores like me, I don't really care. Query and we send an automated form to the taxpayer, but we also know that lower income people are more likely to not fight back. We know that lower income people don't have the resources to defend themselves. Literally, this dude who runs the IRS is in front of Congress stating, essentially, we know if we send out 10,000 inquiry forms, like a CP 2000 or something, I don't know how familiar, I don't want to get too complex. I used to be a huge fan of taxes, folks, and when I had my real job. I used to love forensic auditing, looking for fraud. It was like one of my niches. Anyway, so let's say a regular Timmy gets a form, an automated form from the IRS saying, hello, Mr. Timmy, we noticed that you didn't submit your 1099 for $800. Because of this, you can either dispute this, submit documentation to the IRS, or you can accept it and send us a payment based on, send us a payment of $350 for your $800 you didn't put on your tax return. Seriously. And the guy in the IRS went in front of Congress and said, most poor people will just send us a check and then we get income. We generate revenue for the government. No joke. That is what they say. It is the most fucking ridiculous shit you'd ever see in your life. He literally just says that poor people are easier targets. It's mind-boggling. Why? He goes, well, keep in mind. And then I remember one of, like, some Congress person, I don't know any names, some senator, House, whatever. Somebody says, well, I don't understand. Why aren't you going after the wealthy people or the larger businesses? We do engage in that, sir. Sorry I didn't bring that shit up sooner. We do go after the rich people. There's just a problem with that. When we go after wealthier people, they lawyer up and they fight us for months or years, and it's more difficult to get money out of them. Oh, okay. So let me get this straight. The IRS has realized that poor people are an easier target because they can't defend themselves. So they don't have the tremendous resources. Is that, do we just want to be blunt about it? It is fucking ridiculous. And now I see this new thing, and they're printing money like money machines going burr like crazy. We all know it. And, you know, the value of anyone who has assets and anyone who has inventory and collectibles and real estate or equity, I mean, it doesn't affect people like me. Then you got billion-dollar companies that don't have to pay shit because they know how the world works. They have teams of attorneys. They have international access outside the borders. They have all these ways to circumvent it. I mean, you know, it's like when you pay your employees in company stock. Like, the way the deductions in the system and the way it flows through the accounting and the way the company can write off the fair market value of the stock, even though it's a share at par value of $1. All this crazy stuff, it's unbelievable, and nobody knows. Nobody, the regular working class, gotta go to Taco Bell tonight. Hopefully we sell a lot of the new queso lupas and party packs. I think that seems pretty good. And the regular people are just trying to make ends meet. Okay? There are people out there that do need stimulus. There's people out there that do need help. There's card stores that need help. There's regular families that do need help paying their rent. There's regular people that are going, Jesus, have you seen the prices of food? Why is everything going up? Oh, well, it's okay. I got a stimulus check. Well, what happens when you don't get more stimulus checks and the prices keep going up because you got the previous one and now you got to pay on that previous one for the rest of your fucking life? Is anybody thinking long term? If I have $10 million in XYZ stock, there's no dividend. Let's say it goes up 10% a year. Who knows? Make up something. That $10 million in equity I own, if you have a good brokerage firm, you can borrow against that equity, usually up to 50% of your value. Most wealthy people will usually kind of try to 20, 30%, maybe a third. They don't want to get up to a margin call. So if you have $10 million, let's pretend Rudy has $10 million in Rudy stock. I can go to my brokerage firm and I can borrow $3 million against my $10 million at literally like 1 to 2% interest. Think about that for a second. Do you all understand the power The fucking leverage you could do if you borrow $3 million at like 1.5%? What? At like 150 basis points if you could borrow at that? Like, do you understand the financial weapon of destruction you could do to anything? Collectibles, stocks, real estate? The power. You need to look and make decisions like the wealthy people do to understand that. Now let me explain that further. Rudy, I don't get it. Why don't they just sell $3 million and buy it? Why would they pay even 1 or 2%? Because if they sell the stock, assuming it's all profit, maybe stock options, company stock, whatever. Let's just assume it's all profit. Rudy has 10 million of Rudy stock. If I sell 3 million of Rudy stock and I got to pay 39% long-term capital gains, let's just keep it easy, or let's just make 50% in taxes because I live in New York or California or somewhere with a ton of taxes. Let's just say I pay 50% of 3 million. So I'm going to lose half of my $3 million just liquidating and clicking that mouse button. Or, like every billionaire, millionaire does, I can literally go to the account, withdraw $3 million, ring, sun comes up, okay, I got $3 million in my checking. I now borrowed and have access to $3 million at 1.5% interest with no expiration, no call date, no amortization date. Would I sell $3 million in stock and pay 50% in taxes? Or would I borrow $3 million in stock for the rest of my life and just pay 1 to 2%? You know as well as I do, in the next 20 years, the S&P 500 is going to average more than 1 or 2% a year. So you could endlessly, as a wealthy person, endlessly borrow at stupidly low interest rates that regular people don't have access to. You never use banks and loans and mortgages and car loans anymore. You don't use credit card. You don't care. And then that's the moment you start realizing, holy shit, that's kind of incredible. Holy shit, why am I hearing this from a guy like Rudy on a card channel who doesn't get a haircut? You start to ask yourself a lot of questions. Why is this not discussed more? When they bash billionaires, I wish I was, that'd be awesome, on the news, why don't they explain how they're doing it? Well, that's how they're doing it. Yeah, from a different perspective, you stop worrying. And also, wealthy people have the privilege and the benefit that when the stock market drops, they just buy on the way down. They don't care. Well, Rudy, I've tried buying on the way down, but then buy the dip, right? But the dip keeps dipping and I keep getting slapped. Well, rich people don't have that problem. I know people out there that literally, every time the Dow or something or the market drops, at least like I had a friend years ago where every time the market would drop like 1%, he would buy like 20 grand. And if the market dropped 2%, he'd buy like 40 grand. But if the market had an up day, he would never buy anything. If the market went up for a month straight, he would never buy. It could go up for a year, he'd stop buying. It was a crazy, I've seen that stuff, and it kind of does work. But again, if the market starts dropping every day for a month, a week, 2 months, 3 months, he would buy endlessly on the way down. So no matter how much it dropped, he always came out ahead. Even if he bought the dip, every other day it dropped and it keeps dropping, and you're buying, what's a good example? Was he using Hasbro stock, since, we're talking about Magic, right? Let's say he's buying Hasbro. Hasbro's at, let's just say $100 a share even. If it went to 95, he put 10 grand in. And he wouldn't buy again unless Hasbro went to like 92 or 90. Then he'd do it again. If it dropped more, he'd put another 10 grand. Now, if it stopped dropping and either went sideways and consolidated or went higher, he would just do nothing. He would just ride it and start collecting dividends and let it go up. But every time it dropped, he would just keep buying everything. And if you don't have a limit because you're wealthy, essentially, you can endlessly buy no matter how much it goes down, because eventually it stops going down and you bought all the way, no matter what. And then when it turns, you're immediately making money because you bought everywhere all the way down. So then once it turns, it goes up a little bit. The last few buys are already in the green, and it accelerates the recovery. And that's what these wealthy people do. And of course, not to mention, and I don't recommend it, if you have 10 million in Rudy stock, even if you don't have the available cash, or maybe you don't have the cash for a month or two, you can literally borrow on margin for like 1%. And I remember calling him like, hey, dude, congrats, blah, blah, blah. Captain Timmy, can I work for you? Young Rudy was like, dude, this guy nailed it. And I said, hey, you want to lock in profits? I was kind of, I was a licensed advisor. And I said, look, I recommend, I did the reco, as a fiduciary, this and that, you diversify, lock in your profits, blah, blah, blah. You know what he told me? I said, no, so I ain't selling shit because I don't want to pay taxes. The dude was loaded. I don't know what he did. Maybe he did like breast augmentation or brain surgery or fixed Rudy's hair for a living. Who knows what he did? Maybe he's a taco connoisseur. And I remember, you know what he did? You know what he had me do? He had me sell like 100 covered call contracts at like almost at the money. And he got like a $30,000 premium he collected on his $1 million, like 3%. He collected like 30 grand instantly in his brokerage firm account. Sorry, I almost said the name of the company. And I was like, dude, well, if the price keeps going up, you're going to get exercised and you're going to be forced to sell. He goes, I don't care. I said, but then you're going to have your taxes. He goes, no, I don't care. If I get exercised, right when it dips back down within 30 days, I'll buy it right back and it'll qualify as a wash sale and, it won't count as a taxable event. And I was like, that was the first time I learned about wash sales. I was like, wait, what? I remember, and I learned these things, and this is young Rudy. I was like, all right, I'm gonna go to lunch, and I'm gonna go to Chipotle and spend $7 on a burrito bowl and get some chips, and there was no queso back then. And I was thinking about that all afternoon. I was like, man, I'm driving my little rickety truck, and for my dad, and I still drive that truck to deliver all the patrons' mail. And he told me that, and I was just like, I had like this epiphany moment. I was like, this dude made $500,000. Doesn't want to sell lock in profit. He took option contracts. We wrote covered calls. He sold them to some other schmuck, which I guess made money, not a schmuck, because then the price went up even more. He got exercise expiration. They took his shares, locked in his profit, and then right when there was a dip for like 2 days, he bought it right back. And I was just like, dude, this is some crazy shenanigans, dude. And that's when I learned the power that, again, wealthy people sell tons of covered calls that are way out of the money. That literally have like some 90% chance of expiring worthless. And I remember looking into that years ago, and I was like, okay. And this really wealthy guy taught me, he said, Rudy, we have $1 million. Your covered call, that should be 1 to 2 months out at the most. Don't go past usually 30 days. He said, try to keep, in case the market swings hard, we want to be able to reset that marker on the chessboard. I was like, oh, okay. And also time decay and time erosion, the time premium drops off after 30 days. And I was like, oh, okay. So the value for a $30 contract, 30-day contract is not the same as a 60-day? You don't just double it? He said, no, there's a curve. I was like learning all this stuff and taking notes about theta and time decay. I was learning about the Greeks and everything. And, this shit gets crazy, folks. And this guy was telling me, remember, on $1 million, you should only be collecting 0.5% a month. It's like, 0.5% a month? He said, well, 0.5% is all you should receive on your balance. I said, why so low? He goes, that's how you know you're setting the bar, the strike price so far, the odds of exercising and everything are so minimal, it's probably not going to happen. And I was like, okay. And I remember that. And I remember thinking to myself, why don't you just set your strike price closer to sort of 0.5% of $1 million, which is what, $5,000 a month? Yeah, $5,000 a month for free. I was like, why don't you move it closer so you get like $20,000 a month? He said, no, now you're being greedy and you're being a pig, you're gonna get slaughtered. And I was like, that was the first time I heard that phrase. And I was learning all this stuff, man. Of course. Or actually, no, let's stick with Throne. Throne's becoming a very hot topic lately. Throne of Eldraine. If you're buying these boxes today for $90 or $100 a box in the open market, maybe 105 with tax, who knows? If 2 years from now you're looking to sell the box, the probability of you making good money in incurring the risk of holding this product in the market is going to be very minimal. Because if you can only sell that box for $120 net shipping and fees, as we all know, you're not going to make any profit. Or if you do, it's going to be very minimal. So therefore, you're incurring risk for no potential real justifiable reward. And when you do things like that, that's dangerous. That's rough. Because let's say you put your $2,000, $3,000 life savings, instead of you're just tired of sitting in your checking account, you're seeing all these people on Wall Street bets slinging things and GME to the moon and Bitcoin to the moon and magic to the moon and Pokemon's to your moon. Flesh and blood is on a different planet. And when you see all this stuff happening, it makes you feel left out. You get that FOMO because you're seeing everyone around you, or at least You think that because you're watching social media. You believe everybody around you on social media, which isn't real, is becoming very, very wealthy, engaging in all these hot commodities, all these hot sectors. And you want to be a part of it. And that continues to fuel growth in all categories. The problem is you are not in a situation to leave that money for 5-10 years because the market will cool. The tone will change. We've been through this with reserve lists in 2018. We've been through this with Magic as a whole in the mid-2000s. We went through it with new stuff in Magic in 2017. We saw the reserve list tank in 2018. You're going to see ebbs and flows and hard movements depending on the old trend is your friend till the end until you get punched in the face by Chuck Norris. And that's why it's really up to you. If you're 18 years old, going to college, working a regular job, living it, which I recommend living at home. Don't move out. Don't try to be a hero. Don't go rent an apartment. Don't go rent a house from me. Don't rent and do it. Stay at home with family. If you have a stable life, you're very fortunate to have friends and loved ones that are willing to help you, and you're not psycho, and you can have communication without escalating. If you can do all these things, stay at home. Do not move out and be a hero. Now again, if that's not an option, it sucks. It is what it is. Sorry to hear that. It's going to set you back. If you can do that, stay at home. Who cares what people think? If you're trying to date somebody, well, Rudy, I can't date anybody and tell them I live at home. Wrong. Then if that person doesn't like you because you're at home and they can't see the bigger picture, it ain't going to work long term anyways. Trust me. And you have to understand that you need to do everything you can to accelerate and leave and get older and grow up in this world to be on that path of wealth creation, accumulating of assets, and doing this stuff if this is the type of stuff you're into. Some people don't give two flips. They're not looking to become multi-millionaire. A lot of people just don't care. Seriously. And there's nothing wrong with that. Seriously. It is not always about money. Many things in this world, there's been days that I'm just like, you know what? Sometimes I've even questioned, is it really all worth it at the end? Because there are times when I'd rather just kind of chill out and not do much and just relax. Go outside and kick the soccer ball. Literally, go outside, dig a hole, and be a carrot for a couple hours. There's value to that. Seriously, there's value. Just sitting on a back porch or on a balcony, depending where you live, or on the beach or whatever, and reading a book. And that's all you do for the whole day, and eat some tacos in between, and maybe fool around with your significant other. They're literally simplicity. Don't underestimate the value of that, ladies and gentlemen. But, so when you determine these things, that's why the simple question of when do I sell my investment has no answer. The simple question of what's the best box to buy? There is no best box to buy because no one can predict the future. That's why you need to split and try to kind of diversify into many different boxes, into many different classes, because we don't know. Tools for anyone who wants to hoard and invest sealed product and become an evil investor, bamboozle. And you have to understand some of these things are not going to age well. And you need to, and I understand that, and I accept that, and that's cool. But at the end of the day, you have to be able to split, because when you take the average return of 10, 20, 30, 40, 50 different things, if one or two of those things turn into dragon's maze, you don't really care. Because if you have 100 different numbers and one or two of those numbers are garbage, the average is still going to be very, very high. It won't impact your average. The key is the old, free lunch the only free lunch, diversification, folks. So I think I'm going to end on that particular topic right there. We'll go to something different. So overall, folks, when you determine when to lock in and bring your money back and get rid of the asset or of any class, you need to determine why you're doing it. Are you doing it because you feel it's a bubble and you want to lock it in? Are you doing it because you want to use the money for another investment? Why? Do you think that investment's going to outpace the other one? Are you sure you're not chasing returns? You have to determine why you're making the decision. Did you just get done reading a bunch of posts on the internet or comments or some video from a creepy basement guy or scholars on Reddit or some underground Facebook group? I mean, did they tell you that the hot thing is going to be ABC and new stuff is all garbage? And are you going to continue to buy into that? And then 3, 4, 5 years later, a creepy guy on YouTube makes a video saying, yeah, you should have stayed the course. You got clobbered. And that happens a lot. That happens a lot, everybody. And, it's not, you don't need to be angry, upset about it, but you have to understand that's part of life. I can kind of go that route, but just because something only made 3% a year versus 8% a year, is that really considered? I don't consider that the worst investment. By comparison, you can create any form of chart and create your kind of relativity type thing, but I don't really think that's the right way to do it. And all right, I'll go ahead and say this real quick. So when I was at my original brokerage firm in 2008, 2009 during the crash, one of the things I really hated is that at the end of each month, we'd all get called into a corporate meeting. They would take the 100 licensed brokers and they would rank you all from top to bottom. And the bottom 15% of all brokers at this firm would automatically be written up. And if you got 3 write-ups in a year, you were automatically fired. And I couldn't stand that. I remember I got in an argument in one of these big meetings one time with this corporate exec. And this executive and I, we butt heads. Again, I told you guys, I don't mold well to working for other people and getting a job because I question too many things. And this corporate executive got pissed at me for calling him out in this meeting. And the reason I called him out is I made a comment in front of everybody. And I said, how can you rank everybody and automatically write up and threaten 15 brokers a month their job? What if all 100 people have good numbers? And his answer was, well, the bottom 15 weren't as good as the top 15. And I said, that's ridiculous. So if we have a good month, we make record profit, even though there's still going to be people at the bottom 15, even if they have record numbers. And it created a bias, and I couldn't stand that concept of every month somebody's going to be treated poorly. All right, sorry. It just reminds me of the worst investment, because just because a magic product stays flat, or, you know, what's it going? Return to Ravnica, $120 a box. After what, 10 years? I guess that's my worst investment, right? Because it only went up, what, 3% a year? What, still double the CD rate? Sorry, I get worked up on that kind of stuff, folks. In 2008, when I first started my real brokerage firm, and I got my licensing in 2007. I got my Series 7, which is, you know, the better version of the Series 6. I got my Series 66, which is the Uniform Combined Securities Act, which is a Series 66 is the combined Series 63 and Series 65. The Series 66, so you can, if you have your 7 and 66, you can be a full-blown registered broker, kind of a broker dealer. You can become, you know, a registered rep, as they say in the industry. Registered representative is the technical term, according to the SEC. If you guys, I know you guys weren't really around, a lot of you back then, but if you go back on my YouTube channel, in 2017, I actually have an old YouTube video where I show my broker's licenses. I blocked out my social security number, and I show my broker's license and my test scores on it, because my scores were extraordinarily high. And if your scores are over a certain point, they pull you aside after you take the test, and they actually replay the security camera to see if you cheated. So they held me for almost an hour to replay the footage to see if I cheated, because I scored in the top percentile, which is between the 95% range. And when you score around a 95% accuracy rate, when the national average is about 70, 71, and you need a 71 to pass, they get very suspicious. So it was a very bumpy time from the beginning for me. So when I started in 2007, when I first got my first real job, I had started a smaller brokerage firm, which isn't really small, they're still publicly traded, in North Florida. And that particular brokerage firm, I only lasted like a year. I didn't like the culture with it. I didn't mend well with the older people there, and me being a young gun, a young shot. So I went to the Big Daddy firm, one of the big 3, I guess you could call them. I went to that afterwards, and I stayed there the longest, which was almost 5 years. Went through a lot of ups and downs and crazy crap, folks. No joke, a lot of stuff. My net worth I think, how do I break? Okay, so at the beginning, when I started that job, I owned one little rental house that my dad was big into real estate, still is. And he showed me, and I told him I wanted to get my first little rental house. So I did a little rental house on the other side of North Florida, pretty far away. It's like 30 minutes from me, which I guess isn't that far to a lot of you. And I bought a rental house 20% down. My mortgage was $850 a month, and I was renting it out for $999 a month. I actually got very lucky, had an amazing tenant that stayed for like 5 to 7 years. Then when we finally left, we remodeled the house. I put 10 grand into it, and then I raised the rent to like $1,300 a month from $1,000. And actually, the same person's there as of this filming of this video 10 years later. And I actually paid that 30-year mortgage off, and I paid it off, and I think in 14 years by making instead of the mortgage payment being $850 a month, I just took the entire rent payment, which was $1,000 a month, and paid an extra $150 every month. And then when I raised the rent, I was paying almost double mortgage payments every month. So I paid off the 30-year mortgage, and essentially it was like 13 or 14 years. So it was amazing. So I finally got it paid off. I bought the house in 2005. So it was before the '08 crash. You may be looking at 15 grand for all of it. The collections are minty. You're probably looking at like 25 grand. So, I mean, and it's like, cool, okay, yeah, let's do it, man. And most people prefer, you'll learn the difference between amateurs and people who've been around the block because they focus on risk and safety and they understand the value of things. And I can tell that very quickly when I'm negotiating or I'm discussing and I open up communication with certain individuals. When somebody contacts me and they're saying things like, hey, Rudy, got this Arabian set. Dude, I want 20 grand. I'm like, bro, if it's gem mint minty, I can probably give you like 10 grand for an 80 card Arabian set. If it's played and damaged, you're probably looking at like 5-6 grand. And then depending on the specifics of what cards are damaged, if it's a minty, it's a high-end card or low-end, it's going to swing the price. I'm not going to promise you a certain number without auditing the collection. And, promise you, then I get the cards and, Bazaar Baghdad has Sharpie ink on it. Or your Library of Alexandria, which you told me was in mint condition, I look at it, and then when I put it under bright light, I look at the surface, and it's all dented up from binder ding. And it looks great on the camera when you took a picture and sent it to me. But then it's got binder dings, surface dents. People wrote on top of the card. There's dents in it. And I'm like, okay, well, you have tremendous surface damage, or there's waviness, or the unlimited cards have a lot of roller lines in the back. The black border cards are touch-ups. Well, maybe you got a reback. Maybe your beta card's a clipped alpha, You see what I'm saying? You get these situations, and those tend to be the things that make sellers very angry, or they think you're trying to scam them. And remember, the older the card, the more sensitive the value is going to swing. So, if you have a played, a damaged Bazaar Baghdad that looks like it went through the washing machine, I'll give you a couple $100 out of courtesy, even though it's like mangled like this, But if it's, normal light played, you're probably looking at least $1,000. If it's gem minty, then yeah, the price starts climbing to maybe $1,500. Well, I don't know what the prices are today. Godly, those quotes are probably no good in the last couple months. But you get the idea. The best part about this video, I'm getting ready to wrap it up here, everybody. The best part of this video, when Dr. Timmy number 1, 2, and 3, all 3 of these clients get their monthly statement, none of them see this number in the middle. This number doesn't exist. Actually, you know what? When these clients get it, the entire thing doesn't even exist. But the client who gets the A shares, he'll see the missing 5%. Isn't that funny? Every time you get that statement, you will never, in the next 10 years, ever see the ghost number in the middle. Because it doesn't exist. Because they don't share that. It's amateurized. It's broken down equally over a 365-day calendar. Let me explain that for those of you who do have the interest. Pretty much every 30 days, if your fund has a 1% expense, and you have $10,000 in the fund, 1% of $10,000 is obviously $100, okay? So if you take $100 and divide it by 12 months, it's essentially like $8, or maybe like 1 cent off the share price. So essentially what happens is at the end of each month, they take off 1 penny off the share price. And you never even notice that because you just assume that's the normal market swings. And you don't notice it. And then over a long period of time, before you know it, that's how Wall Street becomes trillionaires and billionaires. That's how people make massive amounts of money. I hate to use some cheesy Office Space thing, but rounding off pennies and doing that long term, but that's really how it works. Seriously. It's the same thing. Dr. Timmy number 3, who's getting railed for 2% a year. So he goes, Rudy, I made 8% this year. And he's all happy and proud. Dr. Timmy number 3 doesn't even realize he actually made 10%. The company took out 2%. It wasn't even on the statement. And he's proud because he made 8%. That's the kicker to the whole thing. And what's even better? When you have like 2008 and 2007, especially 2008, oh my God, you would have a negative 38% return. And the client would get a statement, and his statement would show negative 40%. So he gets angry because he lost 40%, even though it only lost 38%. Because they take that money out and they pay themselves, but it doesn't show up on client statement. Why or how? It was one of the biggest questions. I remember even taking my Series 7 and Series 66 back in like 06. I'll never forget, one of the things I had, even with my university lectures for my upper level international financial management, I think, or economies of scale. I don't remember what class I took. I had an awesome professor. And I remember we had a whole lecture day talking about, for some reason, those don't have to legally be printed. And it always blew my mind. We had a whole lecture on it. Assuming I went to school and all that was real. I just made that up. Sorry, don't ruin my reputation. But that's really it. That's the point of the video today, is that when you don't see it, it feels okay. Look over there, look at the shiny cards, look at the new fancy thing. Run out there and go buy a $6 Starbucks. Don't focus in the long term. You're fee sensitive? Come on down. Let's get you some C shares. 10 years later, you'll get railed for more than anything you ever understand. And that's really it. That's what I wanted to share with everybody. Hope you guys learned something today. Have a great day, everybody. Be safe out there.